John, would you like to start the call?
Thanks very much, Ruth. Good morning, everyone, and welcome to FirstWave Cloud Technologies FY23 second quarter shareholder update. I'm John Grant, FirstWave's non-executive chair. I'm joined by Danny Ma, our managing director and CEO, and Ian Bartram, our chief financial officer and company secretary. We're going to run through the agenda that you can see on the slide. I'll give you my headline view of the past quarter first. Danny will then talk to the key highlights for the quarter before Ian provides more detail on financial performance. Danny will then provide a broader update on the whole business in terms of how the strategy we set at the beginning of the year is gaining traction, and more specifically on the sales initiatives that are being undertaken and the outcomes achieved in quarter two. We'll then wrap up before taking your questions. So I've been with the company for just on 3.5 years, and as many of you know, as you've travelled the same path as me, many for longer, it's been tumultuous. I thank all shareholders, past and current, for continuing to support the company. The good news is that as I sit here today and having consulted my colleague, non-executive director Paul McRae, who's been on the board since 2016, I feel very comfortable to say that operationally, the business is in the best shape it's been since listing. But more significantly, our sales and marketing organisation is in the best shape since listing to deliver revenue growth from the strong pipeline we now have in hand. Of course, the proof of the pudding's in the eating, so let me hand over to Danny to do that. Over to you, Danny.
Okay, thanks, John. So as at the end of Q2, I'm describing the business as growing and manageable is key. I want to say at the outset, in line with John's comments, that I'm very pleased with where we're at. I'm even more excited about where we're going to be. And I'm very happy and confident as a CEO based on what I'm looking at. And I'm very happy and confident as a shareholder too. We have a significant pipeline of sales opportunities, particularly in North America, which indicates a strong outlook for revenue growth. And I'll talk a little bit more about that later. Our normalised cash burn remains under $500,000 a month, which is down from over $1 million per month in the first half of FY22. Our cash burn notably is an investment in our growth, primarily in sales and marketing, and the cash burn will reduce further with the growth that comes from this investment. This quarter, much of that growth is in non-recurring revenues, in particular sales of software licenses. I want to note that while these are non-recurring revenues, this is now part of our business, and they are sales, which is fantastic. They are harder to forecast than recurring revenues, but you're going to see more of them because we're going to be selling more of everything. We've had a really good quarter. I'm going to hand over to Ian to go through some of the financial details first, and then I'll come back later with a little bit more information on the business.
Thanks, Danny. I have a few data points that I'd like to share with you in this update. Starting with the revenue recognised in the quarter, which grew strongly by 10.9%. A significant part of this growth was $650,000 in non-recurring revenues, up 198% on the previous quarter. It mainly related to an MIS9 upgrade undertaken by Claro Dominican Republic. The upgrade included a perpetual license fee and professional services totaling $300,000 in US dollars that we recognised as 468,000 AUD, based on the exchange rate at the time of 0.64 AUD to USD. It is worth noting that we operate Australian and US bank accounts and are currently naturally hedged with a balance of income and expenses in both AUD and USD. We report in Australian dollars based on accounting standards. However, we rarely convert funds and hence are not currently subject to exchange rate risk. This may change in the future. Annualized recurring revenue increased to 9.86 million, a 1.5% increase over the previous quarter. Gross profit in the quarter was up 30.6% to 2.9 million. Some of this increase was due to the Claro license upgrade, which at 100% gross profit margin, and therefore increases the margin as well as increasing the actual gross profit in dollars. Another factor was adjustments to COGS when accruals were reversed out against actual expenses. To get a clearer view of how the underlying business is performing, I have included an additional calculation of the gross profit and the gross profit margin with these COGS adjustments removed. This shows the underlying gross profit increased by 18.7% to 2.63 million, and that the gross profit margin increased by 5 percentage points to 76.3%, which is a strong result for the quarter. In summary, revenue is up over 10%, ARR increased by 1.5%, and gross profit and the gross profit margin are both significantly up. Moving on to the cash and the expenses, the business finished the quarter with 6.68 million in cash and cash equivalents, after cash usage in the quarter of 1.89 million. And there is an additional 1.16 million expected in R&D tax rebates from FirstWave's FY22 tax return and Opmantech's stub return, which relates to the period pre-acquisition from the first half of FY22. Both tax returns have already been completed and lodged with the ATO, and hence the rebates are expected prior to the end of the current quarter. Collections activities were slightly below normal levels, and hence cash usage at 1.89 million was higher than the normalized level, which is calculated against average collections. Taking the R&D rebate and collections adjustments into consideration, the normalized monthly cash burn has been calculated at 0.48 million per month for the quarter. It is noted that this includes 0.2 million per month in the non-recurring revenues. These non-recurring revenues are harder to forecast than recurring revenues. However, they are a significant component of the monitoring side of the business and provide additional cash to support increased investment in sales and marketing, that in turn should deliver growth in recurring revenues. As noted at the previous update, the cost savings and restructuring work has not weakened the business's delivery capabilities, and we remain confident that the revenue growth anticipated from the pipeline, together with a continuing focus on capital efficiency and making the best decisions we can for the long-term health of the business, will improve profitability and see us track towards cash flow break even. Now back to Danny for some more colour around the business's performance.
Okay, thanks, Ian. The last few quarterly updates I've taken just a moment to remind us all of our strategic objectives. So these are to have a sales-led culture right throughout the company, to grow our revenues faster, and to be capital efficient. So everything that we do falls under one of these pillars. We undertook some key sales initiatives during this quarter, second quarter. And firstly, I'd like to welcome Dino Devanzo, who commenced as our new Chief Revenue Officer based in Sydney. So it's a great addition to our team. We continue to grow and have a strong pipeline, providing multiple paths to success. That means we have multiple potential customers in multiple geographies with multiple products. So we have many ways to find our success, and that makes me very comfortable and very confident as CEO. We do have a significant deal in the US, which we are working to close shortly, and we're very excited about that. We certainly don't depend on it, but it's a good one, and we're working to close that shortly. There are other significant deals in the pipeline also, but this one is at a later stage. We're focusing our sales efforts on service providers and large enterprises in our strongest markets, which are the US, Australia, and Latin America. And we're focusing on our highest margin products, which are our network management software and our email security. We announced a new deal with Viera Wireless, which is in line with our strategy of targeting service providers in North America. We welcome them as a new client. And we announced an extension of our agreement with Claro Dominican Republic, which is a key client for us in Latin America. And we also extended our agreement with Telmex, which is Mexico's largest telecommunications provider. So it's great to see those things happening. So these are both extended and growing, by the way. We signed several new clients. They're mostly network management clients, but there's also some cyber decision clients in there. And overall, it was a very good quarter of sales, and we expect to see that continue as we invest further in our growth. So to summarize our current position, it's been 12 months since the acquisition of Opmantech, and the business is a truly transformed business. And what I would say for investors, it needs to be looked at with this transformation in mind and with very new eyes. It's a very different business. We feel very lucky at the acquisition time that we commenced right-sizing and we reset our strategy. So this commenced in January 22, which was ahead of the problems with the tech market. And we got very fortunate with that. So in many ways, we got in front of the market, we got our costs under control, we got our structure right, and we got our strategy right before other companies did. We're growing our teams while other companies are still laying off. Incredibly, our total operating expenses right now are lower than what FirstWave were prior to the acquisition of Opmantec. So the two companies together have a lower OPEX than what FirstWave had as a standalone company, which is quite remarkable. We're investing in our growth and we're showing the early signs of that success. The company is delivering on its goals with strengthening quarter-on-quarter results, and that's set to continue. We have a very exciting and growing pipeline, and we have a manageable and growing business. So on that, I'm going to invite some questions, and I'll hand back to our chairman, John Grant, to facilitate those.
Thanks, Danny, and thanks to those on the call for listening. Let's now take your comments and questions. You can use the Zoom Q&A to key in the question, or you can raise your hand. Over to you. Okay, over to anyone. Any questions? Use the Q&A or raise your hand. Okay, thank you. Oh, we've got one coming in. We've got two coming in. One of our attendees, Danny and Ian, is the R&D rebate always around the same level, or will it change over time?
It's roughly around the same level. It changes based on the number of development staff in Australia, but at the moment, we don't anticipate a significant change for FY23. So we have $500,000 accrued in the R&D rebate at the 31st of December.
Okay, thanks, Ian. Then Mike Paolo says, are there any plans to offer a public offering re-security?
Yep, so I'll take that one. So we have an offsite strategy session with the exec team and a review of products and product market fits, and that is taking place in February, actually. So we might see some updates on that in the next quarterly update, or we may not, depending on the decisions that are made. It's certainly a discussion point because currently the cybersecurity products, part of their key differentiation is that they have a particular value to service providers because they allow service providers to take these products to market at scale. So they're not specifically designed for us to take direct to market. They're differentiated for service providers to take on as an offering. But it's certainly it's under discussion.
Thanks, Danny. David Heaton says, how did OPEX go down so much? Maybe if I just give you my sort of take on that first, David. We had an organisation in FirstWave, another organisation in Opmantec, and we put them together. And that gave us the opportunity to look at the organisation from a different point of view in terms of our costs. But Danny, over to you. You've been clearly, you and Ian have been leading this project.
Well, there was like any company, you can restructure and take costs out and become more efficient, and having a fresh set of eyes helps. So there's just that normal kind of getting your costs under control and restructuring. But then there were some very, very significant synergies between the two companies when we put these together. So it actually became a much more efficient company together. I know that shouldn't mean the OPEX should go down. It should mean it should only go up a little bit. But together with the restructuring and cost controls and the synergies of the two companies, that's what it was. We're running fairly lean on some parts of the company. We've got a heavier slant of our spend towards sales and marketing than either company had prior to acquisition. So it's not just even that the OPEX is lower, it's that the investment is going into the growth as well. So yeah, we're in a good kind of fit shape.
And did you have anything to add to that?
Yeah, just to add to that, we had product offerings. We were looking at product offerings that weren't profitable, and with a focus on the best parts of the business, on the best products, the highest profit margin, we were able to cut away significant expenditure without damaging the performance of the business. So that was the fresh eyes Danny's talking about, and the revised strategy allowed us to make some significant changes quite quickly.
Okay, thank you. Kim Wingery, have the major prospects mentioned last quarter been closed, Danny?
No, so that the major one I'm just referring to again in this update as being quite close. Nothing's done until it's done, as we know, Kim. So we're just continuing to work on that and hoping for some news.
To be hoping, I hate the word hoping, Danny, as you know. I think to be more specific, we're working through our team, obviously, in America, in North America. And that team is working directly with the sponsors within the customer we're talking, potential customer we're talking about. So we're getting the information as close from the source as we possibly can. And that gives Danny and certainly the board the level of comfort that Danny's expressed. Dave Hinton, no risk of clawback on any R&D grant. And when can FirstWave no longer apply for R&D grants in?
No risk on clawback because it's an accrual basis. So the 500,000 that is accrued at the 31st of December is for work that's already been undertaken on the R&D project, which are already part of the R&D assessment from over previous years. So not a clawback risk, but how long we can apply for grants depends on how long we continue R&D investment. And that depends on the mix of investment in sales and marketing versus product and where our focus is. So you may find as products become more commercialized and less R&D has been put into them, that the R&D figure will go down. At the moment, the R&D levels are pretty consistent with previous years.
Thanks, Dan. Danny, how's Telstra tracking as a customer?
So Telstra is a strategic client for us, and part of the beauty, I guess, of having a diversified customer base and a diversified pipeline in terms of lots of different types of opportunities is we can actually put some focus on them as a strategic account as well, because we don't have all our eggs in their basket anymore. So we do have some focus on them. We're working on some initiatives to ramp up revenues with them, including some new tech initiatives, as well as some sales and marketing initiatives. And I don't think I'm at liberty to go in more detail than that, but it's still at a stage, I guess, where we're working together on the next stage of growth. The revenues are fairly steady, I think, at the moment, Ian. Yeah,
just to add to that, because we've talked about Telstra a lot for all the obvious reasons, and they are hard to sort of mobilise. But I've said before, and Danny's gone through this in detail before, we're now working with the sales organisation, so you get a better opportunity to be able to work more closely at the coalface with where the revenue comes from. So we've never been in that position before. So we're in the best position possible to grow revenue out of Telstra, and we will continue to work it so long as we can see the opportunity there.
And I know your Telstra relationships, Mr. Box. Have you putting your hand up to help? You're most welcome. Give me a call.
Yeah, thanks, Justin. I didn't acknowledge your question. Didn't acknowledge you. That was your question. And Kim, again, any comment on the Microsoft relationship?
So that relationship is still one that we're excited about and interested in growing. There's a lot of growth left there, we believe. So for those that don't recall, we signed Microsoft as a client originally, and then we signed another deal with them where we expanded to managing their IoT equipment, their secure IoT devices. There's more growth there, no doubt. Continues to go well as a good relationship and renew, but nothing in particular to report other than that.
I think the extension to that, Kim, maybe it's worthwhile, Danny, talking about the Cisco relationship as well. Where are we at with that?
So the Cisco partner relationship.
Yeah.
Yes, again, I'm not sure how much I'm at liberty to say at this point, John, but so the Cisco relationship we went through, they're still a strong partner of ours, and they're a key product behind the CyberDecision platform that we deliver with Telstra. But yeah, we're in conversations there about some new initiatives as well.
There's a question from an anonymous attendee that talks and asks for further clarity around the government commercial agreement reached to launch a secure, sovereign, ISM-compliant email platform for Australian government and large enterprise.
Okay, so I'll take that if you like.
Yeah.
So the provider of that service did not wish for us to mention who they are. Obviously, it's a secure platform, but we have been rolling that out, and it's currently being built. We've been paid for about half of the build, if that's correct, Ian, with the other half of the payment we're expecting soon. So we're building that out. It's pretty cool, and it's also very relevant to. So there's the Five Eyes nations, which have very similar compliance requirements. So USA, UK, Canada, Australia, New Zealand. So it's a very relevant platform for those markets too. And yes, there's ongoing ARR for that platform as clients sign on to the platform.
Okay. Can I just give a heads up to people on the call? From this call on, I won't be accepting questions from anonymous attendees. I think you need to tell us who you are, and there's no secrets about this. We don't have any secrets in our business, so we'd probably prefer it the other way as well. So just a heads up from the next quarter update on. Any other questions from any on the call? Okay, thank you. Sorry, Mike. Sounds like things are in good shape. Well played. Are the two former product lines still distinct, or are they integrating?
Okay, so there is some integration forming. They're quite useful side by side, but when you say side by side, that means they're still distinct products. So there's some. If you think what the Cybersession platform does, it commoditizes some third-party products, adds a bunch of IP, and makes it more easy to consume at scale and be provided by service providers. So if you think about the Mantech software through the acquisition, it's just another product which can be plugged into the Cybersession platform. So we continue to look at that, and some of that integration is taking place. So we're leveraging some of the IP that was acquired into the Cybersession platform, but generally speaking, I think nature of the question, you'd say there's still two distinct product lines. But we are getting some leverage of the IP. And thanks, Ian. Yeah, go on, John.
Yeah, thanks, Ian. Appreciate that.
So the anonymous question was Ian Leslie.
It was Ian Leslie, yeah. Thank you, Ian. Any more questions from anyone on the call? Okay, thank you very much. We're going to get back to doing business. Look, have a great day. Yes, we're very happy. Bottom line is very happy with where we are. And it's, as it always has been, it's all ahead of us, but there's a greater degree of confidence and certainty around that than I've ever seen in the business. So, and when you hear from Danny as the major shareholder in the business saying that from a shareholder's point of view, he's very comfortable, then that's a very good thing for all of us. Okie dokie. Have a great day, everyone. And thank you very much for joining.